Welcome to the deep dive. Today, we're plunging headfirst into a world that, well, it might sound like something out of a crime drama, but it's far more vital and honestly quite captivating in real life. Forensic accounting. Our mission, like always, is to sift through the sources, pull out those crucial nuggets of knowledge, and give you a real shortcut to being truly well-informed about this, well, pretty intriguing field.
It really is a remarkably broad world. You know, when we talk about forensic investigations, lots of people instantly picture uncovering financial wrongdoing.
Yeah, that's the first thing I think of.
And yes, that's a huge part of it, absolutely. But its applications stretch far beyond just fraud. This deep dive today is really going to pull back the curtain on how these financial detectives actually operate.
Absolutely. And by the end of this, you're not just going to understand the sort of meticulous process behind uncovering financial mysteries. You're going to have some genuine aha moments, I think. Seeing how seemingly dense financial information can be broken down and made completely clear. Okay, so let's unpack this. Imagine for a moment you've stumbled upon something just off in a company's books. What exactly are you looking at? When we hear forensic accounting, what is it beyond, a dramatic scene on TV?
Right. Well, at its core, forensic accounting describes the broad investigative work that accountants perform, normally involving delving pretty deeply into the financial affairs of an entity.
Okay.
And while it's frequently associated with alleged fraud, and that's fair, it's important to know that forensic accountants also handle non-fraud situations. Think about settling monetary disputes when businesses close, or even in matrimonial disputes, or processing complex insurance claims. It really covers the entire process, including potentially acting as an expert witness if a case ends up in court.
Okay, so that's the big picture, forensic accounting. How does that then relate to a forensic investigation? Is that just another name for the same thing, or?
Good question. Not quite the same thing. A forensic investigation refers more to the practical, step-by-step actions the forensic accountant takes to actually gather evidence.
Ah, okay. The doing part.
Exactly, the doing part. In many ways, it's quite similar to a traditional financial audit, actually. It involves a planning stage, then a period for gathering evidence, a thorough review process, and finally a detailed report back to the client. Now, in fraud cases specifically, the purpose is usually to discover if fraud actually occurred, to pinpoint who was involved,
right,
to quantify the monetary loss suffered, and ultimately to present these findings clearly to the client and potentially, to court.
And then there's this other term, forensic auditing. How does that fit into this picture? Is that like the really technical bit?
That's a pretty good way to put it, yeah. Forensic auditing is even more specific. It refers to the precise procedures carried out using traditional audit techniques, but with the unique goal of producing evidence.
Okay, so specific methods to get proof.
Exactly. Think of it as the methods used to gather that proof, for example, identifying exactly how long a fraud has been carried out, or how the perpetrators conducted it, and then, concealed their actions. What's fascinating here is that even seemingly minor details, like how long an undetected fraud ran, that can be crucial.
How long does that usually take to detect,
Well, studies show the average fraud scheme is typically detected after about 14 months.
Wow, 14 months. That's a long time for something to go unnoticed.
It is. And that kind of data, the duration, how it was concealed, often supports other issues vital for a court case.
Yeah.
Like the suspect's motive and opportunity to commit the fraud, whether multiple suspects might have colluded.
Ah, collusion.
Right. Plus physical evidence from documents, things found at the scene, so to speak, and even attempts to destroy evidence later on.
Okay, so understanding these distinctions, accounting, investigation, auditing it, really helps clarify a field that, to the uninitiated, can otherwise seem like just a jumble of terms. It's about seeing the full scope, the practical steps, and then those very specific techniques that reveal the hidden truths.
Okay, here's where it gets really interesting, I think. Once you know what forensic accounting is, let's shift focus. Let's talk about the types of financial wrongdoing that forensic accountants might investigate. Because categorizing them really helps make sense of the huge range of scenarios they encounter.
Right, exactly. You can broadly group them into three main categories: corruption, asset misappropriation, and financial statement fraud.
Okay, let's start with corruption. When we hear that word, it often conjures up these big dramatic images, doesn't it? What does it actually entail in this context? Yeah, it does sound dramatic. And it's significant corruption is involved in about 1/3 of all frauds. It breaks down into a few types. First, there's what's called a conflict of interest. This is where the fraudster uses their influence, their position, to achieve a personal gain that detrimentally affects the company.
Okay.
And what's maybe surprising is they might not even benefit financially themselves directly. It could be an undisclosed personal benefit.
Huh. Like what?
Well, think of it like a referee in a sports game who's secretly betting on one team. They might not get paid directly by the team, but their judgment is clearly biased, right? It harms the fairness of the game.
Gotcha.
Or a more direct example, a manager approving a personal friend's inaccurate expenses,
Right.
maybe just to maintain that friendship, even if the expenses aren't legitimate.
Wow. So even that a manager approving a friend's dodgy expenses just to keep the friendship, that counts as corruption, even without direct financial gain for the manager.
Yes, it detrimentally affects the company.
That really flips the traditional idea of fraud on its head a bit.
Okay, and then the ones we often hear more about, bribery and extortion. How do they fit in?
Precisely. So bribery is when money or something else of value is offered to influence a situation.
Offered. Okay.
And extortion is basically the opposite. It's when money is demanded to secure a specific outcome, someone forces the issue.
Right, offered versus demanded. Fascinating how nuanced that can be. Okay, moving on to the most common category you mentioned, asset misappropriation. This sounds like a bit of a catch-all for theft.
You're spot on. It is by far the most common type of fraud. Its common feature is simply the theft of cash or other company assets. And while it's the most common, it's interesting individually, these cases often lead to the smallest financial losses for a company compared to the other types, but they're incredibly pervasive.
So more frequent but smaller scale usually. What are some examples? Think of simple cash theft, like literally stealing petty cash from the premises. Easy to understand, still happens. Or slightly more complex. Fraudulent disbursements. That's where company funds are used to make illegitimate payments.
Okay.
Common forms here include billing schemes, payments going to fictitious suppliers that don't really exist.
Right. Shell companies and such.
Exactly. And payroll schemes. That's where payments are made to fictitious employees, often called ghost employees.
Ghost employees. Heard of those?
Yeah. We also see inventory frauds, straightforward theft of company inventory, stock, and misuse of assets, where employees use company assets for their own personal interest, like using a company car for a long personal vacation, not just commuting.
Okay, so it covers a huge range of what we might just call internal theft, from petty cash to these ghost employees. Got it. Finally, then, there's financial statement fraud. This one sounds like the big leagues. High-level stuff.
It often is, yes. Financial statement fraud, sometimes called fraudulent financial reporting, is a type of fraud that causes a material misstatement in the financial statements.
Material meaning?
Meaning it's big enough that it would actually influence someone's decision. Like an investor choosing whether to buy shares based on those numbers, or a bank deciding whether to grant a loan.
Okay, so it has real consequences. How do they do it?
Various methods. It can involve deliberate falsification of accounting records, just changing the numbers, or the omission leaving out transactions, balances, or important disclosures from the financial statements, or even the misapplication of financial reporting standards, bending the rules, essentially.
And the goal there is?
The intention behind this is often to present the financial statements with a particular bias, to make the company look better than it is, usually. For example, imagine a company hiding a chunk of its debt just before a big loan application to look healthier financially than it really is.
To improve the ratios banks look at.
Exactly. That's off of the game here. Concealing liabilities to improve the company's apparent liquidity and what's called gearing analysis, which is basically looking at how much a company relies on borrowed money versus its own equity.
It's really incredible how recognizing these patterns, corruption, asset theft, fudging the big reports, can give you such a deeper understanding. You start seeing it in financial news or even just, everyday business situations you might encounter. It really clarifies where the digging deep actually happens. So, okay, we know the types of fraud. How do these experts actually conduct these investigations? What's the process? Take us through the blueprint of a real case, step by step.
Right. Well, the process of conducting a forensic investigation is in many ways quite similar to a financial audit, as we touched on. But, and this is key, comes with some crucial additional considerations that make it pretty unique.
Let's start right at the very beginning then, accepting the investigation. What's the first hurdle for a forensic accountant? Can they just take any case?
No, definitely not. The first step is for the forensic accountant, or usually the firm, to assess whether they actually possess the necessary skills and experience to take on the work. Forensic investigations are highly specialized, you see. They require really detailed knowledge of fraud investigation techniques and a firm grasp of the legal framework involved.
Right, it's not just accounting.
Not at all. Investigators also need specific training in interview and interrogation techniques. And crucially, they need to know how to maintain the safe custody of any evidence they gather. That's paramount.
Okay, that makes total sense. But this raises an important question for me. What if the client asking for the investigation is also an audit client of the same firm? That sounds like a massive conflict of interest. Is that ever truly okay?
That's a critical point. You're right to raise it. And it absolutely introduces significant ethical considerations. If the client is also an audit client, the investigating firm could be exposed to threats to its objectivity. Things like self-review threats, advocacy threats.
Yeah, you can't really investigate yourself impartially.
Precisely. Because of this, unless very, very robust safeguards are put in place, and sometimes even then it's questionable, the firm generally should not provide both audit and forensic investigation services to the same client.
Okay.
And just from a commercial standpoint, remember these are specialist services, so high fees are typically negotiated, reflecting the complexity and the fact that you're usually involving very senior, very experienced team members.
Right. Specialist work, specialist fees.
Yeah.
Makes sense. Okay, so once a case is accepted, ethically and practically, then comes the planning stage. How do they strategize? What goes into the plan?
Yes, the planning is meticulous. The investigating team must carefully consider what they've been asked to achieve by the client. The objectives are often quite specific. Identify the type of fraud, figure out how long it's been operating and how it was concealed. Then identify the fraudsters if possible. Quantify the actual financial loss suffered by the client. Gather evidence that can be used effectively in court proceedings. And finally, provide advice to the client on how to prevent this kind of fraud from happening again.
That prevention piece is huge, I bet.
It really is. And during planning, they'll also consider the best way to gather evidence. Noting, as we said, that computer-assisted audit techniques, or CATs, are very common and very powerful in fraud investigations today.
Right, the CATs. You mentioned them. Those sound like something out of a spy movie. What exactly do they do? How do they work?
Maybe not quite spy movie level, but they are sophisticated. Think of them as digital detectives, really. CATs can sift through literally millions of transactions in seconds, flagging anomalies or patterns that a human might take weeks to find or miss entirely.
Like what kind of patterns?
Well, for instance, they might identify every single payment made on a Friday afternoon to a vendor with only a P.O. box address. That could be a red flag for a fake supplier, maybe.
Oh, okay.
Or they could help identify the exact timing and even the location or terminal used when specific details were altered in complex computer systems. It's incredibly powerful for tracing those digital footprints fraudsters leave behind.
Wow. Okay, that brings us to the sort of boots on the ground phase, gathering evidence. What's the most crucial thing there once they start digging?
Well, to gather really detailed evidence, the investigator has to truly understand the specific type of fraud they're looking at and exactly how it was committed. It's not just about finding something wrong. The evidence they gather needs to be sufficient to prove the identity of the fraudster or fraudsters, the precise mechanics of the fraud scheme, and the exact financial loss incurred.
Precision is key.
Absolutely. And it's utterly critical that the team is skilled in collecting evidence that will actually be admissible in a court case. And equally important, maintaining a clear, unbroken chain of custody for that evidence.
Chain of custody meaning?
Meaning they had to document exactly who handled the evidence, when, where, and why from the moment it's collected until it's presented in court. If evidence is inconclusive, or worse, if there are gaps in that chain of custody, maybe a document was left unsecured for a while that could be challenged by the defense or even ruled inadmissible by the judge.
So a small mistake there could wreck the whole case.
It absolutely could. And investigators must also be constantly alert to the possibility that documents are being falsified or maybe damaged or even deliberately destroyed by the suspect or suspects trying to cover their tracks. I actually recall one case years ago where the most crucial piece of evidence wasn't some complex financial statement at all. It was a simple, repeated typo in an invoice number across dozens of fake invoices. That little slip-up ultimately led us down a rabbit hole to uncover the entire scheme.
Wow, a typo. So it's not just about finding the numbers, it's about making sure every piece of evidence, big or small, can stand up under intense scrutiny in court. What are some specific techniques they use to gather this critical evidence?
They use a whole range of techniques, really. It depends on the case, of course. but it often includes testing the company's internal controls to identify the weaknesses that allowed the fraud to happen in the first place.
Finding the gaps.
Exactly. Using analytical procedures, that means comparing trends over time or providing comparatives between different business segments or against industry averages to spot anomalies. Applying those computer-assisted audit techniques, the COTs we talked about, to analyze large data sets. Conducting discussions and formal interviews with employees, not just suspects, but potential witnesses too. And employing substantive techniques like detailed reconciliations, physical cash counts, and thorough reviews of supporting documentation, like invoices and contracts.
It sounds incredibly thorough.
It has to be. And, ultimately, a key goal for the forensic investigation team is often to obtain a confession from the fraudster, if fraud did indeed occur.
The confession.
Right. But for this reason, investigators usually avoid directly confronting the alleged fraudster until they've gathered sufficient independent evidence to support that confession and challenge any denials. The timing is crucial. That interview with the primary suspect is a truly critical part of the evidence-gathering process. Very high pressure.
I can imagine. Okay, so after all that meticulous gathering, digging, interviewing, it's time for reporting. What does the client typically expect to see in that final report?
Well, the client will definitely expect a very detailed report laying out the investigation's findings clearly. This report typically summarizes all the key evidence gathered. It concludes on the amount of financial loss suffered due to the fraud as precisely as possible. It discusses how the fraudster actually set up the scheme and, importantly, which specific internal controls were circumvented or failed.
Okay.
And as we mentioned regarding prevention, it's also very likely that the investigative team will include recommendations for improvements to the organization's controls. The aim is to prevent similar frauds from occurring in the future.
Closing the barn door, so to speak.
Exactly. Learning from what went wrong.
And then, as you've hinted, often these investigations lead directly to court. That must be a whole different ballgame entirely.
It absolutely is. The investigation is very likely, especially in significant fraud cases, to lead to legal proceedings against the suspect or suspects. And members of the investigative team will probably be involved quite heavily in any resulting court case.
How so? As witnesses?
Yes, primarily as expert witnesses. The evidence gathered during the investigation will be presented formally. Team members may be called to the stand to describe that evidence, explain their methodology, and detail how the suspect was identified. It is absolutely imperative that these team members can present their complex findings clearly and professionally. That's key.
Because they're talking to judges, juries, people who aren't accountants.
Precisely. They often have to simplify very complex accounting issues so that the non-accountants involved in the case, jurors, judges, maybe even lawyers, can fully understand the evidence and its implications. It's all about making sure the truth, however complex the numbers behind it might be, is accessible and understandable to those making the decisions.
You can really feel the meticulous, high-stakes nature of this work throughout the entire process, knowing that every single step, every detail, contributes not just to finding the truth, but to seeking justice and maintaining the integrity of our financial systems.
Indeed. And just to summarize, really, a forensic investigation is a highly specialized engagement. It demands a team with deep skills, not just in accounting and auditing techniques, which are foundational,
right,
but also critically in the relevant legal framework. They investigate this vast array of fraud types we discussed. And because these investigations so often lead to legal proceedings, the team members absolutely must be comfortable, credible, and clear when appearing in court to explain their findings and methods.
And that, for you listening, has been our deep dive, hopefully a unique shortcut to understanding a complex and, I think, pretty critical area. Full of surprising facts and meticulous processes, we've gone from the core definitions, what is forensic accounting, to the sometimes surprising ways fraud manifests itself, and right through the meticulous blueprint of an actual investigation. What really stands out to you from all of this, and maybe to leave you with a provocative thought to mull over, beyond just the mechanics of uncovering fraud, what does the incredibly meticulous, court-focused nature of forensic accounting tell us about the broader pursuit of truth and accountability in a financial world? It's clearly not just about the numbers, is it? It seems it's also about validating narratives, ensuring fairness, and holding people accountable when things go wrong. Something to think about.